Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. What's up, everybody? Welcome back. Very excited for this first economic and merger and acquisition update on the new podcast. If you want to check out some of the older ones, all you have to do is go to my YouTube channel and you'll see years of quarterly economic and merger and acquisition updates. These started a couple years ago when I started talking to ITR Economics and wanting to bring the economy and the things going on in the merger and acquisition marketplace to all the owner operators who have to make very big decisions every day about allocating capital, making big decisions about funding your company, taking distributions, reinvesting. What is going to be the return and what are your options, and constantly trying to stay aligned with what your long-term goals are. And so I got involved, and I've been very appreciative of my partnership with ITR Economics. So Brian Beaulieu is going to be on the show today, like he has been for a couple of years now. And we're going to be talking about the leading indicators, what's going on with the economy. I love his material. And then the second segment is with Jeff Buettner from ButcherJoseph, where he talks about what's going on in the merger and acquisition marketplace, valuations, multiples, debt, deal structures, a lot of different ways of monetizing your asset. And then I've got Tom Walker on the show from Walker Insights, and he's going to be talking about how to be thinking about capital allocation as an investor in privately held assets. And he's got a lot of very unique ways of thinking about equity and how to fund your growth of your company and assets. If you want to jump ahead to one of the topics and one of the guests, all you have to do is check out the show notes for the timestamp of when each segment starts. You'll learn a little bit more about what we talk about in that segment, a little bit more about the guest. And if you enjoyed this episode, share it with any of your friends trying to get the word out. And I would really be grateful for anybody that's willing to leave a review on the podcast player that you're listening into, trying to ramp up the new reviews with the new show. Thanks everybody for tuning in, and I really hope you enjoyed this episode. So Brian, I'm excited that you're joining me again. I appreciate this. We're back at it, new podcast brand, but we are here. I actually had a conversation with ButcherJoseph already, and there has been a decent amount of things that have been going on for the last 6 months since we chatted last. It sounds like you got a vacation after the integration of ITR. Your team is doing well, and so congrats, and I appreciate you being here again.
My pleasure, Ryan. Good to see you. It's really been 6 months. Really?
A little bit longer than that, yeah.
Wow.
I know.
That explains
the Minnesota summer.
More gray in your beard, I suppose.
After a summer with my kids at home and managing the summers, I maybe if I grew my hair out a little bit longer, there might be some there because I'm excited for school. Let's put it that way. So you guys, I was going through all the updates and stuff like that, and you and I have talked about going. We've taken these conversations from kind of the bigger picture of like, hey, what's going on? 2024 is coming closer to a close, and and happening fast, and then you got the 2025 growth. And I'm starting to see how that's coming to fruition with rates coming into the conversation again about cuts. And I was looking at the leading indicators. Any place that you want to start, given the fact that it's been 6 months?
Yes, I don't think that I don't want people listening to think that the rate cuts is some sort of immediate cure for the sluggishness that's in the economy. It doesn't work that way. You just briefly mentioned the leading indicators. They're softening as we speak. Consumer spending, but not real well. They're barely covering the rate of inflation, if that.
Mm-hmm.
We look at how much consumers are savings, and their saving level is, in dollar terms, flat as a percent of their disposable income. It's the weakest we've seen since 2012 or 13, something like that. I mean, it's not roses and sunshine out there right now. There's still some stormy weather, and I'm sure the politicians are going to be able to make great hay out of that stormy weather.
Well, and that's what your value is we're going to cut through that noise. And I have referred people to The Prosperity and the Age of Decline. I don't know how many times, Brian, in the last 6 months about like, hey, go pick up that book because it's so important to think about this in the spirit of what you can do in making the moves. Your other book and I actually was down in Sioux Falls, and Tom, I was sitting down with Tom Morgan, and like the amount was 3 different groups that were just singing the mantras of ITR, and their whole deal, Brian, was get it straight by 28. I was like, it's great. So like, I don't know, man, you got a bunch of cheerleaders out there, but I think it's the mindset, and you even in your update had like the cup half full, cup half empty, what to do about it. I just got done talking to Casey Brown on my podcast this morning, the pricing expert. And I actually brought up some of the conversations we've had in the past about different moves that you can make, especially in the next 18 months. So it's slowing down. So as like the media kind of gets hold, but then like, what are you doing with your business? I think there's some interesting opportunities that people can be putting into place to look towards the next, 18 months. But like, so with the sluggishness and stuff, like how should people be thinking about like the slowing down of the 24, and then what potentially the timelines of the more accelerated growth next year? How should they be kind of thinking about that for their business and what it means?
There's many different layers to the answer. One is continuing to lead with optimism. We're not about to go into a recession, but acknowledge that there are some squishy parts out there. There are some soft spots in the economy and probably in their markets. There's no sense denying that. But by the same token, we refresh the analysis almost every day. And just today, our VP of Economics, Jackie Green, is affirming that, we expect things to get better in the second half of 2025. And that this is actually a great time when interest rates are coming down. Skip a few beats, like maybe 2-3 quarters, and be able to be willing to leverage up if you need to in order to invest in yourself to really spring forward in that rising trend. Never waste a good business cycle. Mm-hmm. And while others are still full of fear and trepidation come March or April, you should have your plans. You should be ready to execute on those plans ahead of your competition, because as the economy grows and you have a larger market share, I hope, then it's an even better rising trend for you. And at the same time, and that's why I was thinking it was multifactorial. Mm-hmm, mm-hmm. I don't want people to be beguiled by the fact that we're currently in an environment where the Fed can lower interest rates. That's not going to last very long. The Fed and the economy has already set the seeds. The government has already laid down the seeds for inflation to come back quite noticeably 26, 27, 28, 29, 30. So enjoy the respite, but figure out your strategy for even beyond 18 months. But I would use the next 18 months for sure to determine my best tactics and my best strategy. And then those tactics for dealing with margin squeeze that is coming.
I like how you laid out the multifaceted there, because I think that this ties so much to what I was talking about with my my ownership coaching group, Brian, that I've now got. A lot of them are sitting, call it around $1 million-ish in normalized EBITDA. So some decent sized, healthy middle market companies. And from manufacturing to professional services to like commercial cleaning is one of them, steel fabrication. I'm just like, it's the real economy, Brian, which is so fun when I'm working with these people, but they're seeing some pressure. So they were talking about pricing, and like all of a sudden the value-based pricing is becoming more difficult. And I started talking about some of the strategies you talk about, make your move, like, okay, here's how to be thinking about, if everybody else is looking at the mania, whether it's the recession or if it's the growth next year, laying the groundwork that they need for the 2028, 2029, I think is kind of how I'm regurgitating a little bit of what you said, but I think it's so important to be thinking about this now, as you might be doing some things that are counterintuitive to what everybody else is doing, but you're laying the groundwork for that longer period. And as you're talking about the interest rates or the inflation going up, Brian, this has a lot to do with like how correlated it is to the demographic cliff, the Great Depression that you keep talking about, like with the people leaving and them having to finance the deficits. I mean, like how much of these big money cycles are tied to the inflation, and how I saw a couple of charts where the money supply is growing again. And is this having to do with the demographic cliff and what's kind of leading towards that 2030 that you guys always talk about?
Well, the money supply and the demographic cliff are really two different topics. The money supply has to do with the Federal Reserve for many cycles now accommodating the federal government's addiction to deficit spending. In the old days, as you know, the Federal Reserve would be the counterbalance to that, say, no, you're just going to create inflation. We're not going to let you do that. But these days they say, okay, we'll provide the money to make that happen. They've sort of given it up. That has a lot to do with the next round of inflation, as does the fact that we are in a tight labor market despite the sluggishness in the economy, and that's not going to go away. I mean, even if we opened up our borders to a lot more legal immigration, we simply would not have enough people to fill the jobs that we have today.
And then that's going to continue to get worse because of the demographic issues, right?
Yeah.
Yep.
Longer term. Yep. And that just feeds on to, so you have a labor price.
So two compounding forces there.
Yeah.
Yeah.
And I'll give you one more. And it's, as the Federal Reserve, as the Treasury goes deeper and deeper into debt, government goes deeper and deeper into debt, we're already spending $1 trillion a year on interest payments. $1 trillion, Ryan.
Is it like 100 every 100 days or something? It's ridiculous.
It's only going to get worse, which means they're either going to have to print more money, or they're going to have to find some fiscal discipline someplace, or they're going to raise taxes, which will be hurtful for the economy. So,
I know. I have to I can't have to recite the mantra of your book title. Prosperity in the age of decline. Prosperity in the age of decline. And but I think it's really important because I have more times than I can count over the last 6 months been talking about, referring people to your webinars about the different age demographics. So where you're at in this cycle will be really important. I'm different than half my clients. Half my clients are my age. Half my clients are in a different age bracket. And it's okay, well, what they want to do with their asset will be determining based on their energy level, their risk tolerance. And it's interesting, kind of give you kind of a layer deeper of this philosophy that I have now with this independence by design. Brian, is think about the business as an owner, not just as an operator. And you've been talking about that for however long, but capital allocators, right? So if they can get their income through distributions while someone else is running the company, then they can think about what their business is, from a capital allocator perspective. And then therefore, I think your material at ITR becomes even more important because it's what's the risk of your future cash flow as an investment? Because it might be better off where they hire the CEO, reinvest back in the company because you have a good business that over the next 5 to 10 years is needed no matter what. But then getting that bigger picture through your material, I think is more important than ever.
I absolutely agree. We run a program through ITR called Financial Resiliency Analysis.
Oh, nice.
And what we're doing 10 and 15-year forecast of companies, private companies, out therefore 2034 or 2000 through 2039. And one of the major goals of that is for these owners to be able to look at this and say, is this the best way for me to make money? Or is there another way for my family, build a family office and make money that way?
Yeah.
Right? They tend not to be able to visualize that conversation until they see what their own trends are likely going to be.
That's fantastic, Brian. And I just, in a previous episode, I geeked out to next level on weighted average cost of capital, the build up methodology and cost of capital, because I'm trying to help people think your money's stuck in your equity in your business right now. Is the best place to keep it there, or is the best place to put it other places? And that's how we need to be thinking about this. And
the equity in their business, Ryan, should be negatively correlated to their portfolio of investments.
Yeah.
Or else their equity goes up and their other investments go up, but then they both go down at the same time.
Right.
That just increases the beta of your worth as opposed to trying to stabilize it so you can plan on
it. In unbelievably well said. And thank you for pointing that out. And I think what I have been just beating a dead horse with, Brian, as this independence by design ownership framework is if they can figure out how to reinvest and actually hire that $250,000 CEO so they can decouple themselves of the job and think and take a deep breath and think about this stuff, then it's not, I want out and it's out of everything. It's more of just okay, to your point, there's half my clients. It's where are you going to put the money? You should keep your business because you have a good, commercial cleaning. It's not going away. It might be soft right now, which is look at the next couple of cycles and figure out, okay, well, whether it's commercial cleaning or if it's home services, it's not like the marketing agency or some SaaS product that is not, there might be some major issues there if there's that much competition. And anyways, I say all that because as we continue this conversation, it's like in your data, it's capital allocation. So then it's like for acquisitions, investment back in the business, it should be about the return from an investor's perspective. And I think this is where like my philosophy and your philosophy just completely intersect and your stuff becomes more relevant than ever.
Do the people you work with look at their return on equity? They
are now. They have no choice.
Good, good.
I actually have this, and I'm curious on your thoughts because I've been following some of these people online, and I wanted to know how sound you think this thought process is. So I've got this woman, Tracy Beck. She has a company called 60 Minute CFO. She has built out a basic 3-statement model template for people where they can plug in their history for the last 4 years or 5 years, the income statement, their balance sheet, and then do some inputs for the future. And it's nothing like, PhD level sophistication of every part of their GL structure. I mean, you're talking like the top 10, 15 accounts, but where you can see the working capital, the cash flow, and the analysis. And then we have a tab there that's return on equity, and there's an owner's tab. And it's like, you got to have at least 12%. Essentially, and like where I've got that from is like, I mean, if there's 8% money growth and 12 or 4% inflation, there's some people out there that are saying you got to be growing at 12% to kind of stay in the same spot, or you could put your money somewhere else. But at least we're trying to look at that return on equity. It's like if you can get your money, if you can get more return somewhere else, quit doing all this. It's hard.
Right, exactly. Now, I was thinking about that CEO that you were talking to that says, spend $250,000, hire another CEO. The return on investment for him doing that is exponential if he's really an entrepreneur. You just freed up his mind to be able to do other things.
Time and mindset. Yeah.
Some people are going to be afraid to give up that power. And that's probably why some businesses don't grow beyond 5 million. Some don't grow beyond 10 million because of that very self-limiting factor that they put on. And you can help them through that, which is really cool.
Yeah, and it's really interesting, Brian, as I have built out this new ownership framework. So I like the hyphen of the owner operator. There's EOS and scaling up and OKRs for the operator and the operating framework, but there was no ownership framework, is what I've gathered over the last 10 years. And so I've got this ownership framework of time, cash flow, and wealth. And the business has to be the flywheel machine that essentially creates more time, should create more cash flow, should create more wealth, but the wealth frees up our time. But we have to extract that job so we can think about this as a capital allocator, because it's like, well, all the smart money has been buying these companies. So we already have the companies. So should we just like figure out what they're doing? And we already done the hard work. But then it's that eliminating of the ego to step outside of that job, which you and Alan did a great job. You said you landed the plane without any casualties when you talked about your integration with Crow. And it's like, that's awesome, right? You've built a team where it's not about you and you can free up your mind. And I think about the stuff that you're talking about is so important. And going back to, you talk about your financial, what was it? A financial literacy or what? Financial
resiliency.
Financial resiliency. So I was talking to Kimberly on one of our monthly calls, and I was trying to better understand your guys' forecasting tools and stuff like that. And she said, I mean, it's sales, right? It's not every GL code. So like, I thought it was interesting is I always, in some of our passing conversations had thought it was more levels of detail that I think about the lack of data in some of the middle to lower market. Maybe explain like how your forecasting works. Cause I mean, we've talked so many times over so many quarters about your leading indicators and all this stuff. But if we bring it into that company, what are you doing on that? Like forecasting out the sales and how to tie it into this like level of foresight about how their business and their sector plays into the bigger picture.
Yeah. Well, it really starts with the 30,000 foot view. And that's my job and Jackie's job. And that's what's the basic framework going to be like for the economy, this sector, that sector, over the next 3 years, over the next 5 years, over the next 10 years. Okay. Then you get in this company and get a detailed history of what markets they are servicing. And we look, well, how does that fit into this framework that we built? How has this company historically performed relative to this framework that we have built? Have they overperformed? Have they underachieved? It's funny, it's amazing, Ryan, sometimes what you can tell. I was looking at a company recently, helping them. And I said, guys, I don't know what you did in 2004, but that had nothing to do with the economy, that weakness. I don't know. I don't know what was going on. And I said, in 2011, something else went on there. But that wasn't the economy. And I said, do you remember that far back? And he looks at me and goes, yeah, I know exactly the mistakes I made.
They usually do, don't they?
I said, well, good. Don't do those again.
Is it more like people, customers, products? I mean, some bad investment? I mean, is it kind of a combination of all those different things potentially?
Yeah, it's probably good decisions, just bad timing. You know?
Oh, interesting. Yeah.
It often comes down to that, right? I mean,
yeah.
Knowing what they knew after the fact, they probably would have waited on some of their decision making, but they didn't. But so that, I mean, we can get to that level of understanding how a business is supposed to be performing through these cycles.
Mm-hmm. And, well, because context provides so much peace of mind, I think, because like I'm thinking about my client that's a steel fabricator or the commercial cleaner or the home services provider. I mean, like all these different people. I mean, they're feeling some softening, right? And then they're trying to look at them because I'm helping them try to come up with the discipline of measure the value of your company every single month. So you're looking at the return on equity and the value, based on the multiple, the debt and the EBITDA. And like, we're just having a baseline, right? Like this is not like over engineer, but we're having that mindset. But then it's like, okay, we're softening and to avoid the panic. It's like, well, the whole industry is softening and you're above your peers but then this is where the business cycle will go. And then I think that's where those moves that you talk about over the next 18 months. I mean, I think people have the ability to lay the foundation over the next 18 months that could pick the winners and losers by 2028 and 2029 in my thought process.
You know enough of what we do. I mean, each of those different businesses, there would be different benchmarks that you could tie them to literally just show them, look, you're not alone. This isn't you. It's not a company problem. It's a market problem. It's going to be resolved based on ITR, if nothing else. So let's get ready for the other side of this rather than spend a whole lot of wheel time, brain cycles on something that we can't control.
Well, and like 100%. And I think about the people that are not doing that, how much they can be taken advantage of by the professional investors who are going to use what they already know as common knowledge to them of like, this is a cycle, to go and feed off of the fear of someone that thinks that this is going to be doom and gloom forever. And they get something at a discount, essentially.
Right.
Yeah, I think this is where I'm so excited, Brian, about like the fact that I get to focus on content and coaching now. I can focus on tying together all the most important service providers that the clients need to be working with instead of having essentially, because I had one fractional CFO services that I had to make sure people were marching towards, where now it's like, okay, like if the big picture is cash flow through distributions, growing cash flow, growing equity, like there's just a lot of different ways people can do that, but they need to be focused on the right thing. And I think the data that ITR and the different service offerings and kind of the tiers that you guys have is just unbelievably important for people to just start digesting and start thinking about this stuff and giving context.
The people in your organization, not your team, but your clients, I mean, how versed were they in the balance sheet and understanding their own balance sheet before you started working with them? Because I find so many small cap businesses, they understand the P&L a whole lot better than they do their balance sheet.
I think you're correct. And like, honestly, at some point I should send you a screenshot of so I did 2 workshops last week for the Independence by Design owners workshops. And each one of them had about 40 owner operators in there, about the same size I was talking about, called between $500,000 and a few million in EBITDA. And what I have realized, Brian, and is like what I went through in the family business 15 years ago, like we were running a $20 million business. Look at the income statement. We have no idea what the hell we were doing. We sell more copiers, sell more IT services, and there will be hopefully money in the checking account. And I think what's so fascinating is why is that possible? That I did 50 VISTAs workshops over the last 18 months, and call it 1,500 to 2,000 people have been through my material. Most of those people were very similar, where they were able to look at just their income statement because of the Fed quantitative easing that hit in 2008, and everything went up and to the right. Because Brian, for 15 or 10 years, I'm like, how is this possible that these people got this successful without looking at a freaking cash flow statement? And then the only way you get to a cash flow statement is by looking at the two differences of a balance sheet over a period of time. So I teach in my workshop, I'm like, because I only want to know distributions, taxes, debt, and working capital, like to fund the growth of this thing. And the only way we can get that is if we have two correct balance sheets. And then so people go, I don't know what's on my balance sheet. I was going through with a client. He's like, it's 380 grand. He's like, I'm not sure. Like, my accountant said it's this, you know what I mean? They're just looking at the income statement.
Part of that Great Recession growth, though, was businesses are pretty easy when you start off with zero market share. It's only when you reach a certain size and your expenses get to a certain level that and you are talking about more sophisticated metrics than you need when you have 0.5% market share, whatever your market is.
Interesting point. Yeah.
But as the numbers get bigger, you need to become more sophisticated, or else, to your earlier point, you will get swallowed up.
Mm-hmm.
There's no doubt about it.
So I know we've only got a few minutes here. What are some of the things that you and your team are focusing on paying attention right now? Because I'm looking at some of the leading indicators, and 2025 is a lot of green, which is cool. Is encouraging, I should say. But what should be on people's minds between now and our next conversation?
Don't expect the president, whoever that is going to be, to come to your rescue or fix things overnight or defend you or any of that other stuff that you hear. You're running a business. You either own it or you're running that business. So it's up to you. It's not up to some politician to get your act ready for the next cycle. And whether it's Harris or Trump, there's going to be another cycle. I mean, you can take that to the bank.
Yep.
You get ready for it and stop worrying about what you can't control.
Well said. Pick up your guys' books and then go back and listen to some of the previous episodes that we've done. But also, ITR's got amazing resources. So, is there anywhere that you want to point them? We'll put the links in the show notes. Any webinars coming up? Any other? I mean, the trend.
We have webinars every month, but the next one on the 2030s is going to be in December. It's the last one I'll be doing with Alan.
Oh, cool.
Because he gets to retire before I do. Rumor has it we'll be wearing tuxedos, but that remains to be seen. It'll be fun. It'll be epic.
That's good. And I got to give a big shout out to Taylor. I was on your podcast with him and he did a great job. And I really enjoyed his style. He's bringing a lot of value. So you've done a really good job of building out the team. Congrats.
He's amazing. And he's starting a family, and I think he's going to be an amazing dad. His wife is going to be an amazing mom.
Starting means he sounds like he's pregnant.
I get excited about the future. I can't.
That's awesome. So starting a family means it sounds like he's pregnant. He hasn't jumped into or I shouldn't project. I don't know, but it's when you say starting a family, does he have a kid yet, or is he married?
You know what? There's some things I can't talk about.
Well, good. Congratulations, Taylor. Welcome to it. It's I'm a solo dad.
It's the best thing that can happen to you, right? So it's all
I'm
good.
Solo dad duty for 2 weeks here, so I totally get it. Brian, this is I appreciate you so much, and this has been fun. And I'm excited to keep these going, and I'll put all the links to ITR in the show notes.
All right. Thanks, Ryan. It was great seeing you again. Always a pleasure.
Jeff, how are you today? Excited for today.
Ryan, I'm doing well. Thanks for asking. How's your summer been?
It's you know what? I'm in Minnesota, so I love my summers, but I've got my daughters who just went back to second grade. And when I heard parents in the past go, I can't wait for school, I now understand completely. So yes, it was good. How was yours?
Yeah, very, very busy. A little too short, as I'm sure yours was as well, but all good. I'm excited to get together with you again and chat about what's been going on.
Yeah, me too. And it's fun to have you back on the show, the new show, and we'll be continuing to do these quarterlies. We got the ITR folks as well, and I'm excited, Jeff, because I have the ability now to just lean more into the bigger picture for my audience of how are they making these decisions, Jeff? So I'll put a container in there with the new tight focus of the owner operators that I'm working with, where their bigger decisions, Jeff, are if I want to maintain my income through distributions, like that's the whole, like the main focus of the independence by design is like, okay, how are we shifting our salary over to distributions where they can take their income through distributions and then they can do whatever they want with the value of the company. They can monetize it, some of it, all of it, none of it. But they get, at the end of the day, they're essentially having that cadence of ownership calls every month, almost like they're a private equity. And I think the material that you're talking about is more relevant than ever as they become what I call more capital allocators. So like the decisions of like partially ESOP, no ESOP, all the stuff that you're talking about is even more relevant. And then understanding the economics of what's going on in the deal marketplace are the decisions that are important as a capital allocator. So long story short, excited to continue diving into what we've been talking about. So where do you want to start? I mean, like I think the last call we did was for February, something like that. So we got a little bit of time underneath our belt.
A little bit of time's elapsed, yeah, since then. I think you're right. Your recollection's correct, and that was probably the last time we got together and chatted about what we're seeing activity-wise. I would say that since then, there's been some things that have evolved, as you might imagine. In the valuation space, there's been some evolution in the financing markets. And obviously, we continue to, at a macro level, sort of monitor what the Fed's next move might be. And now we have this impending, presidential election on the horizon, and
nothing going on at all.
We start to hear, conversations around, what might happen with tax codes. So yeah, there's a lot.
There's lots to unpack. So let's start with maybe, because I think it's a good place to start of like, I mean, everybody is now watching the Fed like a hawk and like interpreting whether Jerome Powell sneezed to the left or to the right. Because I mean, maybe I'll give you like some thoughts that like behind what I'm thinking, Jeff, is like, I just watched what happened with the yen carry, that whole situation of how fragile the market is, of like an extra 25% increase about blew up $20 trillion of liquidity in the marketplace. So I just think about like lending, buyers, leverage, that was just a big data point for me. I don't know if it's the canary in the coal mine, but like, how are buyers and lenders thinking about all of this stuff? Because of just, how fragile everything is.
Yeah, well, I'd say that, from a lender's perspective, there hasn't been a whole lot of movement in terms of pricing or in terms of what I would call the leverage coverage. In other words, how much leverage is available to a particular business. I think there's still a interesting dichotomy between the amount of pricing at the lower end of the market versus pricing at the higher end of the market in terms of company sizes. A lot of that continues to, prevail, and that's something.
Can you explain a little bit about that to the listeners?
Meaning that the rates that companies are going to pay if you're a smaller business will be in large part higher than the rates you might pay if you're a much larger company. And there's some inherently a lot of the reasons for that is because there's a little bit more risk to the smaller businesses that are in the larger companies because they're more diversified and have different revenue streams, different geographic coverage, and a variety of different things. So we haven't seen too many changes, on that front quite yet. But we might see a little bit more of that, I think, once we start to see the Fed move. Obviously, the Fed has 3 meetings left in this year to make a decision. I think the prevailing thought clearly is that rates are only going to go down from where they currently are today. I think the rate of progression of the decline is still something everybody's
up for debate.
Their arms around, whether it's 25 basis point increments or maybe something a little more than that in one of the 3 meetings for the rest of the year. But I think generally speaking, the prevailing thought is that rates will come down. And so you have a lot of businesses that are watching that thinking, well, if I don't need to do something right now, maybe I'll sit on the sidelines a little bit. Kind of wait to see how this thing plays out. And obviously, if rates are only going to go down, then I might be refinancing into an environment where I can get cheaper credit than I can today. How is the market going to change in terms of availability and leverage? Leverage points. The theory would be that those would improve along with the reduction in rates, and the competitive environment would improve.
It's self-reinforcing, isn't it? So funny. It's like, well, if everybody thinks they're going to go down, then people don't do anything right now. So therefore the economy gets worse because it's not growing. So therefore, it's just like this self-reinforcing, Yeah.
Yeah, exactly. So we're seeing a little bit of that right now, and that's kind of, I think, one of the unique things about this point in the year that we're currently in, right? I mean, we're so close to the next Fed meeting that I think that could be the catalyst for the first sort of change. And I think the market will be watching that very, very closely. Now, having said that, I think what we have seen in the first half of this year, and certainly since we last spoke in February. We have seen activity. I mean, we have seen transactions close. I think it's been mostly limited to maybe the smaller end of the marketplace, smaller companies. And I think some of that, that we've seen is really kind of a hangover from deals that maybe started the prior year, and there's this just prolonged process that's transpired. I think we talked about that the last time we spoke, is just transactions are taking longer. Right, because
more due diligence
there's more diligence. There's more people looking at the revenue of a target business and the earnings of a target business and the margins of a target business. And there's been inflationary dynamics, particularly in the labor market, that's been sort of compressing margins for a lot of businesses. And so to the extent you were a buyer of a business, or you're a company looking to get financing and you're seeing that your revenue and your earnings are maybe not quite tracking to budget, it just gives people a little reason to kind of continue to watch and prolong, either the acquisition process, A, or B, the financing process. And that just means that some of the deals that maybe would have normally on a sort of a normal cadence closed in 23 got pushed into 24, and now we do see those closing, and so we do see some activity, which is good. I think it's again a lot.
Is there any industries or sectors that are noticeable out of the activity?
I think it's those companies that are going to be a little bit more asset intensive, that have assets to lend against, really, that are going to be the ones where you've seen a little bit more activity. I think private equity, has been active at trying to continue to make tuck-in acquisitions, which are going to be a little bit smaller companies. And if you've got the assets to lend against, you can obviously, finance those transactions, and they can put in a little equity behind it, and then, tuck that into a platform business. So you still see some of those types of things going on that I think is increasing, the activity levels generally.
That's it makes sense. And it's so fascinating, Jeff. I just did a couple episodes diving deep into weighted average cost of capital and like the cash flow valuation, where the multiple comes from and stuff like that, to like a pretty ridiculous extent. And it's the belief of the future cash flows, where like all the assets, whatever they are, need to be generating that future cash flow. How is it like the people, and I know you guys in the GF data and some of the stuff you guys talk about, I can't remember the terms, but like the ability for someone to prove their story of their future cash flows. Are you seeing a different value or deal structure benefit for the people that are able to prove out those future cash flows? Because again, like if you don't have, because I say this in here, so I'm thinking out loud, but it's like, you might not be as an asset intensive, but if you can prove future cash flow, that could be a great thing. Maybe not for lending, for like, the kind of the back of the napkin, like you have enough stuff for me to grab, but like what we want is future cash flow that's predictable and sustainable. So like, how are you seeing people's appetite on that, or like the advantages of that?
Yeah, absolutely. I mean, I think it behooves any company looking to attract a buyer, looking to attract financing, for a transaction, to be able to tell a good story around where the revenue and the earnings is going to come from going forward, right? And obviously, to the extent you can communicate to that universe that the capital that you need is for accretive purposes, that certainly increases the availability and your ability to get financing, number one, but also more attractive financing terms, number two. And that's the type of stuff that I think is super important. Those types of accretive stories, or making acquisitions, for example, right? I mean, what we've seen is certainly within the last year, notwithstanding maybe a little less activity out of the private equity universe, we have seen more strategic companies making acquisitions a bigger part of their growth strategy. Not just organic growth any longer, but hey, let's go out and augment our organic growth with being really aggressive and making acquisitions for our own business, taking a competitor out of the marketplace, trying to create some synergistic revenue that really sort of can add a lot of value to the business.
Well, and I'm curious on the why behind that. I mean, and here would be my thoughts is like, if you're a strategic buyer, because I've seen the same thing. So I've got a group of owner operator coaching clients now, Jeff, and I want to talk about some of their stories and the things that we're seeing as a group now. But like, I think about one of the things I was talking about with this Ken Sangenario about weighted average cost of capital and like how many companies do not grow faster than their cost of capital. And that has become disproportionately screwed up since the interest rates went up. So how many of these strategic buyers are doing this out of necessity to grow faster and to put more debt on it to grow faster than what they might not be growing otherwise? So there's like a reason behind what they're doing.
Yeah, that's the corporate finance reason for, to do it, right? It's to make sure that you can your earnings profile is growing faster than your cost of capital. And I think what we've seen is a lot of businesses that have a really, what I would call robust corporate finance team, look up and say to themselves that, hey, maybe right now, without some incremental revenue streams, we might have a hard time outgrowing our cost of capital, particularly when a lot of these businesses locked into credit agreements that were floating in nature, right? And so as SOFR increased and the spreads increased, now all of a sudden, all else being equal, your fixed charges went up because your interest costs went up overnight, all right? And even if you didn't have a floating rate structure and you had more of a sort of a term structure, a fixed rate structure, that term might have, come to maturity. And now you're sitting there trying to refinance from a low rate environment into a high rate environment. And once again, overnight, your interest costs just perhaps potentially double, and so now that necessitates a revisiting of all your growth strategies. Can we really grow organically to offset this much, much higher cost of capital, or do we need to do something different, that's a little bit more proactive and really think differently about the outlook of the business? And I think a lot of corporate finance teams looked up and came to the realization that if we just sit here in the status quo environment and we just
it ain't going to work,
it's going to be really, really hard. We really need to make acquisitions a bigger part of our strategy, and they've really sort of doubled down on that strategy.
So super awesome clarification. So I want to run a couple of decision trees and kind of think through them. So a lot of the people I'm working with call it like they're $1 million to a couple $1 million normalized EBITDA, and they're owner operators, Jeff. So they're not part of that game that you were just talking about. They should be thinking that way, and that's why I'm talking to them. Right? They should be thinking as a capital allocator, but the financial engineering that you just mentioned of corporate finance of the bigger companies is not there, right? All of their equity is generally stuck up into this company, and they have to look up and say, okay, well, where's the best place to keep my equity? Is it in this company? Is it somewhere else? So I've seen quite a few of my clients where they've gotten one of the big strategics in their marketplace do exactly what you're just saying. And I'm like, well, as a seller's perspective, I'm like, well, you have a higher chance of getting your money up front. And to hit your wagon with an earnout, rolled equity, or any of this crap where all of a sudden you're now signing up for that game versus right now that they just can, they should still be thinking about the return, but they don't have to do something like you're saying. And so there's this kind of decision tree of third party sale versus not, how much money up front. And if I say, if you get all your money up front, where are you going to put your money? That's one of these questions that I'm telling people, is it treasuries? Is it, and it's weird, Jeff, because we go through this huge decision tree of maybe you should go buy a commercial cleaning company, which is what you have. Because that's where the smart money is going.
Yeah.
So there's this weird decision tree that is kind of circular in nature, but I any thoughts of the owner operators who are not part of that complexity, but should be thinking like this? And because you guys at ButcherJoseph are working with ESOPs, management buyouts, third party sales, private equity. You're spanning the exit options of monetization. But if you enter this kind of thinking, what do you think people should be? How should people be thinking about this kind of stuff?
Yeah, I think it's an important part of the, sort of the annual process that, the owner operator should be going through. And I think it's a part of the process of determining, how you're going to put your company in a position to ultimately be sold into the marketplace as well, right? And maybe you're not even thinking about selling today, but on the horizon at some point in time that you're going to want to take your business to market and sell it to somebody. What are the things you can be doing today to really improve the attributes of your business so that when you're ready to go to market, you've really got this, much more sort of polished product that you're bringing to the market, which will only help you command that much better pricing and attract that much more interest than if you kind of haven't done a lot of this, what I would call window dressing in advance of that, and then try to bring it to market. And a lot of it, can be, just in the margin profile. A lot of it can be in your debt profile. A lot of it can be in kind of how you've been able to demonstrate growth. Your ability to manage debt, your ability to grow through acquisitions. All of these things demonstrates a leadership team that is experienced at managing all these complexities, managing debt on the balance sheet. I don't know if it's necessarily going to allow you to kind of get 100 cents on the dollar at closing, because I think we typically are seeing, at least in this environment, most buyers of businesses expect that that founder owner is going to roll a little bit of the equity at close back into the the entity.
Well, and that would that be more common for private equity? But do you see that with strategic buyers?
Yeah, we do. We've been seeing.
Oh, no way, really?
Buyers. Yeah. For some of the similar reasons, you want to make sure you've got, particularly if you're buying a business and you want to integrate that business, you might want to have that founder owner stick around for a year or 18 months to help with the integration, just the transfer of the day-to-day operations. I don't think anybody's, these strategics are expecting the founder owners to stick around for 10 years.
Are you seeing like equity role or just more like of an earnout? Because like I just find that fascinating, because a lot of strategics I feel like want to protect their cap table versus private equity, which is more in the sharing of the upside or phantom stock or something.
Yeah. No, I think we've seen a little bit of both in terms of equity, but also certainly the concept of an earnout, I think is a tool that's often being used. And again, from a strategic buyer's perspective, if they can demonstrate that they see a lot of value in the joining of these two businesses in terms of either revenue synergies or B cost synergies, it allows them to get comfortable with, hey, maybe there's an opportunity to structure, a little less of a purchase price up front, but at the end of the day, with the achievability of these synergies, that founder owner who's sold ultimately might be better off once some of those benefits are actually realized.
Yep. So I think this ties, what you were just saying ties into, I want to walk you through like my philosophy of what I've been working on with Independence by Design as it relates to this owner operator and growing the value and like having these options and hear your feedback because of how many how it impacts what I'm about to say impacts the deal structure and their options, because you guys span the options. What I think is fascinating is that, so if someone that's doing, call it $1 million or $2 million in normalized EBITDA, and they have the ability to reinvest to reduce their risk, reduce their weighted average cost of capital, therefore increase their multiple. I mean, they should have a clear sight where that return is pretty obvious compared to putting it somewhere else, because they've got opportunities to do that unless they've hit their best in class. But what I like this philosophy, Jeff, of like the goal, because like, I've had like just challenges, I think psychologically with these owner operators with the word exit. I think it just messes everybody's heads up. And it's like, well, if the goal is to have as many options, what most people I find want back is they want their time back. So if they can get out of the job, it's like, okay, well, if we can figure out how to get your income through distributions without your labor, so then we can then bring in a CEO, comp the CEO based on phantom stock. So annual bonus plan plus long-term bonus plan. So it's like maybe an annual based on working capital, distributions, and normalized EBITDA, and the long-term based on normalized EBITDA and debt and the multiple. So like if they can afford that person while they're taking their income through distributions, and then they're doing this, like, I mean, they're managing it as an owner, management buyout, ESOP, like smaller companies, SBA loans. But I say this because like, I guess the back of the napkin when I'm trying to explain to people, Jeff, is like, if you could take those distributions and flip those to debt, you could do whatever you want. Cause like you're proving that your company can prove those payments.
That's right. Exactly. You're just replacing the purpose of the cash flows is being, flip from one ultimate end purpose to another end purpose, right? Instead of distribution, goes to principal and interest payments. And so that's exactly right. And then you can structure something that if you're accustomed to distributions being X, then you can structure something so that principal and interest payments are X. And then, you've got kind of 6.
How does that then layer on, like when you because I think what's so fascinating about what you guys do at ButcherJoseph is you have to tell the story for that future buyer, right? So you're taking the story and maybe what would that, if that situation was accomplished, Jeff, how would it impact that owner's options on deal structures or options between an ESOP, management buyout, third party, just kind of what would that do for you to represent something like that?
Well, it just increases the optionality that exists, right? I mean, you're not going to be forced to go only one route because you have demonstrated a variety of, attributes that afford the ability to pursue a variety of options. And that's the key, really. You want optionality, right? As a founder owner, you don't want to be forced to make a decision. You want to be able to be proactive in determining what decision makes the best sense for the business, for you and your family in terms of a liquidity event.
When your role, like you were saying, because would your role, when you think about an ESOP versus a private equity versus a third party, how would they look at that founder if that situation was accomplished? I mean, would there be a high degree of earnout? Would you be able to represent someone and say, hey, by the way, this person in an ESOP could flip to a board member, or what would that do to that role?
Yeah, so clearly, if you have an established management already in place, as you suggested, maybe the founder owner is starting to put the plan in place to step back and be a little bit more of, call it a absentee owner, bringing in a CEO, bringing in other executive members of the team, really sort of building out that C-suite for lack of a better word, or a leadership team. Then that's going to make it easier for a private equity firm to say, okay, this individual, although is the current shareholder of the business, really isn't running the day-to-day operations, right? And we can get greater comfort around the business on a go-forward basis that the existing leadership team will remain in place and kind of not miss a beat. That is also true of an ESOP structure, by the way, because in the ESOP structure, I mean, really not much changes in terms of the leadership team, right? So as you're thinking about going to the debt capital markets and borrowing money to finance the ESOP's purchase of the business, that lender's going to want to know, well, who's the leadership team and who's running this business day to day? And okay, I see the shareholder is X, this individual, how active has that person been in the running? Is there a key man risk there? Or is that person really sort of stepped away for the last 18 to 24 months and the leadership team is really in place that affords this individual to kind of step back and not have to be involved in the day-to-day. And I, as a lender, don't have to worry that there's going to be any sort of stubbing of the toe, so to speak, once I lend all this debt onto the balance sheet. And that impacts the amount of,
the cost of capital, the debt, the structure, everything.
The structure. I mean,
how about personal guarantees with ESOP? Because a lot of times people want to get out of it. Because when we were breaking down the cost of capital, Ken was like, it's not just the cost, but it's the personal guarantees and it's all the hooks and all that stuff that actually increase the effective risk of that. But with ESOPs, maybe you can speak specifically to that, because I think a lot of people have those questions about ESOPs, about how are their personal guarantees, and if that's as accomplished, how does that take place?
Yeah, I mean, in terms of personal guarantees in the traditional sense, those are what banks would require, right? A personal guarantee against whatever debt that is being borrowed, and I think that there has been an opportunity. We've been involved in a number of circumstances where we've run a competitive process to find a lender to lend into a transaction and been able to successfully negotiate out personal guarantees. That was very, very common 24 months ago. I mean, or maybe 36 months ago at this point. Time is racing by. But yeah, no, I mean, and a lot of that will depend on some of these factors, right? And a lot of it's also going to depend on the size of your business, to be quite honest. And the lending community generally might find a little bit more comfort in removing personal guarantees for larger versus smaller businesses. For smaller businesses, though, there's there's opportunities to go to the SBA and get an SBA.
I just did a podcast about the SBA. There's a gentleman that has done 2,000 SBA loans, and so he was talking a lot about this. But that's on the smaller end of the market, where you guys are talking more Yep.
So what the goal really is to find the right sort of lender that makes the most sense for the business, right? And makes the most sense for the objectives of the founder owner, and that's ultimately, I think, how we would approach each one of the clients we work with, is trying to find which lender is going to make the most sense as a partner.
Well, and I think, Jeff, what's super fascinating, again, I've just been such an advocate for ButcherJoseph because you approach it with, it doesn't matter what route the person wants to go, because you have capabilities of helping them with what route is best for them. When I think about so I try to bucket the valuations into the cash flow valuation, and there's the strategic, right? Where the strategic, you might get a premium. You and I have talked about this on some previous episodes, but the cash flow valuation is what people can manage to, because they can highly predict it. And because I said, maybe as we continue to these conversations, it's like the stuff that we talk about what's going on with the deal volume and lenders and different industries, that's the third party kind of perspective of it. But maybe speak to how you have worked with people of there's both options, right? You can control the cash flow valuation, which is ESOP, management buyout, the lending, where it's really just lending compared to then the third party. How would you help someone kind of think through, or what are your thoughts on that concept, and how someone should be thinking about those two concepts when they're owning their company?
Yeah, I mean, I think that the way to be thinking about it is kind of, this, what I would say, for lack of a better term, is sort of a status quo valuation, right? You've got a revenue streams, you've got a cost structure in place to support those revenue streams. And those would be maintained on a go forward basis. And on top of that, you then would layer in, principal and interest charges on any borrowings, any debt that you would borrow, right? And that sort of status quo valuation is based on the cash flow generation of the business. It doesn't give consideration to, any cost savings from synergies, or any revenue synergies from increasing your sales channels or increasing your customers, because now you can sell multiple products through your sales channels. Whereas a strategic valuation, that can, capture some of that incremental value, right? And obviously that only comes with the ability to be acquired by a certain buyer, right? A certain company that can extract these synergies. Financial buyers like management buyout and ESOP buyout aren't going to be able to extract a lot of synergies because they don't bring synergies to the table. But a competitor might, because you might not need two factories, you might not need two CFOs, you might not need two back offices, and again, you might be able to sell now your products through multiple different sales channels to multiple customers that the company in its current form doesn't currently sell to and has the ability to sell through. So that's where that incremental value comes from.
Well, I think it's a great concept, and how you laid that out too, of because I think about, I'm anticipating when you and I chat again in probably November, December, whenever that goes out, all of the stuff that you just mentioned is going to come to fruition. How many points or how many basis points are we down in rates? The election goes down. There's a lot, but when I think it's important to constantly be reminding people is that those things you can't control. And if your only option is a third party buyer, then what's going on in the things that you're talking about will influence their options, the activity, the deal structure, versus if they're doing both at the same time, focusing on that status quo valuation, then is it a safer or a safe comment to say then you have less, it's less up to the whims of the marketplace? I mean, obviously the lending, it has an impact on that, but you don't have as much randomness as far as what might happen.
Yeah, well, obviously there are forces outside of your control in terms of the Fed's decisions and the lending community and their assessment of risk and how they underwrite to risk. But certainly there are things within your control, and that's the stuff that you can control within your business. And I think that anytime you can prove to be an above average financial performer in your space is only going to benefit. Going to benefit the options that you have available and help position the company in a way that's favorable to a buyer of a business and the lending community.
Two further questions is before we wrap up is you do management buyouts, correct, as well, not just ESOP? Because I think it's if someone could prove that cash flow valuation, then what is the ability to then go to a lender and then work with a management team to then get the lending that is necessary based on the company's performance versus the net worth of that management team?
Yeah. I mean, at the end of the day, that's what it comes down to. It's a leverage buyout being driven by the management team, right? And obviously being able to demonstrate again the growth outlook for the business, clearly looking at the borrowing capacity of the business are going to be key. To the extent the management team, has capital put in, great. That only makes it, necessitates less borrowing. But we don't often find that the management team is going to come to the table with really, really deep pockets. And in fact, most of the time, what we see is management comes, those 2, 3, 4, 5 individuals that are kind of pulling their resources together that are the existing management team. More often than not, they come to the table with very little capital. And so you're really talking about, a leverage buyout that's being led sort of by them. And then you have to demonstrate, of course, the company's ability to generate the cash flows to repay that debt.
Which would be their tenure, their ability to hit performance metrics and all that stuff. And I just think it's so, like, Jeff, because I had this guy call me up, client of mine, dear friend. He's like, well, I got this guy that wants to buy me. And it was like, how much money down and how much is an earnout? And it actually ended up being a seller's note. And I was like, it was just a simple question. I'm like, because this guy it was like one of those acquisition entrepreneurs and going to come in, and it's a bigger sized company. And I said, like, what's your confidence that this person's going to be able to run the business better than you and he's got a current president. He's like, I have no idea. I'm like, why would you just do seller financing to your current manager? Like, because the goal is like get more money up front. I'm like, that's where that management buyout or the ESOP comes into play. It's like, you have the ability to get more money up front with the current team that doesn't need the liquidity or the net worth.
Yeah, no, exactly. I mean, we've seen, certainly in the marketplace instances where management or the seller has sold to existing management team and just taken 100% seller note, right? And so all you've done in that position is you've got no liquidity at close, but all you did is now make yourself a lender, and now as a lender of this business, you've got.
You just changed your equity position to debt position without a whole lot of reward, which is
you moved up the balance sheet a little bit, so to speak, but
correct. But subject to making sure that they can pay those payments. To your point,
but you've also now limited your upside, right? So like the business takes off, maybe you would have just preferred staying an equity holder, or at least maybe you would have preferred to at least get some liquidity at close. And then, have a little bit less exposure to the future success of the business with the leadership team that obviously is in place.
So, final question is, what is the role that you see, like if someone's capable and understands why it's important to do an ongoing valuation? Because I like one of my comments in all my workshops, Jeff, is that most people say, I'll never know what my company's worth until someone decides to write me a check. I'm like, well, BS. If they're listening to the podcast or they're in my workshop, they know that's not true, because ESOPs and private equity firms and public companies do it every day. So but if someone is a privately owned shareholder of an owner operator business and they're getting this mindset, how often and what is the way that they should be judging and keeping track of their internal valuation or the status quo one versus the third party? I mean, what role do you see that?
Yeah, no, I think it's important, because what it does is it provides sort of a really valuable independent look under the hood, right? You're looking at someone's coming in looking at all the good things about the business and identifying the good things, but more importantly, you're identifying maybe where the business has some blemishes, for lack of a better word, or where it falls short in certain areas. And those are
it's your fix-it plan. It's your right.
Yeah, and those are opportunities to now kind of improve on those deficiencies. It's also an opportunity to get a assessment of where and how the market and the buyers of businesses in that space are going to look at your company. They're going to identify strengths. They're going to identify weaknesses, opportunities, threats. They're going to sort of stack rank how strong or weak you are on these certain characteristics and these attributes of the business. And to the extent you can demonstrate you've got more strengths than weaknesses, all that does is increase your attractiveness and the value that your company brings to the marketplace, and vice versa. And so if you're somebody that is thinking, well, I don't really need a valuation because I have no plans to do anything today.
It's such a stupid comment.
Why not do a strategic valuation today, get a fair assessment of what your business is worth, identify what the weaknesses are, what the markets is going to tell you your weaknesses are, how the market is pricing your company today, and then think through, okay, how can I improve my business over the next 4 years so that when I'm ready to go to market, I've identified all these deficiencies, I've corrected them. All I've done is improve the value of my company now. I've improved the attractiveness to a broader universe. And you also might be selling into 5
and you
years
didn't make it up yourself
marketplace than today.
Yeah. It's like, it's so funny, Jeff, because like, no, I think, being facetious here, I think I'm going to go into my conference room. I'm going to make shit up of exactly what I want to do and what everybody's going to value and just blindly do things for the next 4 years and just hope it all works. I mean, it's literally asinine when we think about it like that. Like, I think about I don't know if you feel comfortable giving ranges of like what those valuation, like, I know it's complexity of how many entities, how big and all that kind of stuff. So I don't want to put you in any hard position, but like, I'm just such an advocate for what you're saying, because like if someone has a decision tree of spend $40,000 or $20,000 or whatever the hell it is on a strategic plan, I think those are really important. And then there's the operational stuff like EOS or whatever, but like, I'd rather have someone who's going to actually write me a check, tell me what to do, versus, some random. So where do you see all this, and what does ButcherJoseph do that kind of stuff? The ongoing valuations for even people that don't.
Yeah, absolutely. We do it all the time. We'll do strategic valuations and help folks identify, kind of what the market would say their business is worth, where the deficiencies might lie, where there's opportunities for improvement. And if you think about the return on investment, I mean, these companies trade at multiples of EBITDA, right? And let's just say it's a 5 times multiple of EBITDA, right? I mean, and just, hypothetically, if you can identify a way to improve your earnings by $100,000, that you get a 5 times multiple on $100,000. So now, that business is now, that effort is now worth $500,000. And maybe the valuation cost you $40,000.
It's an add back, first of all.
$50,000. It's an add back for valuation from purposes anyways. But obviously you've just generated much more value to your business and more than offsets the cost of the valuation.
Well, and if you do,
a lot of times people don't think of it in terms of I think the easiest metaphor we always use is you think about kind of like a house, right? Eventually you want to sell your house and you have to invest in maybe an outdated kitchen, or if you've got a leaky roof, you need to fix this before you take it to the market and try to sell your house, because all that's going to do is depress value, because someone's going to say, I'm not going to give you top dollar for your house. The walls are falling down. There's a leaky roof, your bathroom's outdated, your kitchen's outdated. How about you go in and you spend some money right now to pretty the business up, because you're going to get more return on your dollar. And unlike a house where you might get 60 cents on the dollar, 80 cents on the dollar, in a business valuation, you get multiples of earnings.
Well, and like if you increase it by $100,000 and increase the multiple from a 5 to a 6, I mean, that's major accretion while paying down. But I think what's also even another factor in this, Jeff, is like, so I have 3 to 5 clients right now that got an out of the blue offer. I've only been working with them now for a couple months since I launched the new gig. So therefore, that's the caveat here, is they don't know what their company is worth. They're like, well, maybe I should hire an investment bank. I'm like, yeah, how? We have no foundation to stand on for negotiation. Like, you should know what your cash flow valuation is and know exactly how at the end of the day, if you knew what your management buyout valuation was or an ESOP, that's your second buyer. I mean, how do you even have any discussions with someone unless you have any idea where you're at and what you could do over the next 5 years? There's no context for that discussion at all. It's totally crazy.
No, that's a great point. Yeah. I mean, you think about, offers out of the blue, and you don't really have a lot of good information to make an informed decision unless, maybe perhaps you've been doing some of this legwork all along. And then you have a really good idea of how that opportunity stacks up to kind of what maybe the real market value is. Because it's not uncommon for people to receive offers out of the blue from buyers that are looking to with lowball offers, trying to strategically pick up an asset because they see an undervalued asset that, they can extract value out of for themselves. And if you don't have that insight, then at the end of the day, you're not going to be perhaps the one that enjoys the full value of the asset. It's going to be someone else who was able to opportunistically see that and sort of take advantage of that.
It's so damn important, because That's why I don't like the words exit planning, because it's like if you're doing an ongoing valuation, it's just capital allocator and you're just choosing to keep your capital in your current business like all the other investors do, right? And so it's this decision around where's the best place for your return is the game.
Yeah. We worked with a client actually based in St. Louis many years ago where the management team came to us and we did this very same exercise. We did sort of a strategic valuation. We identified kind of these attributes of where the company was solid and other areas where they were weak, and helped them put a plan in place and really sort of bolster the operations day to day. And ultimately, at the end of the day, they sold to a strategic buyer about 3 or 4 years later. And in between then, we were continuing to do valuations to help kind of track progression and kind of see how they're if they were actually achieving, the objectives that were identified, how it was impacting the earnings, and where the market was that at that point in time, to know how the market would now reprice that business based on these improvements. And then they could kind of get a real sort of insight annually as to how they were moving along, to then be in a position when this strategic buyer came along to be really smart about
terms, conditions, all that stuff. Well, and like your rocket fuel on that is aligning that CEO and management team with annual bonus programs of like working capital distributions, normalized EBITDA and a phantom stock plan. And which is what people do after when they typically do an ESOP or private equity. But it's like, well, let's do that ahead of time and just play the same game is what I'm advocating for.
Yeah. In this example, that's a great point. We put in a deferred comp plan so the senior leaders of the business were participating in the earnings growth of the business. And then when the business was sold, obviously, not only did the founder, the majority shareholder, obviously get liquidity, but there was a liquidity event for those key leaders of the business in the deferred comp program.
That's awesome. I want to respect your time. I know we can keep going. This has been a great foundation, Jeff. I think laying out our concepts, because I know there's been a lot of kind of what I feel is like the calm before the storm over the last 5 or 6 months. So instead of going through the data of like point by point of what's going on, I think this will lay the groundwork for like when you're back on next time. I'm sure there's going to be a lot to talk about interest rates, deal structures, all the activity that's going on. So this has, I think, been a good conversation. Where can people find ButcherJoseph and get in touch with you guys?
Our website is ButcherJoseph.com, and you can see all the things that we do. And my contact information is on the website as well, so folks can. You
guys got a bunch of, and shout out to Jack who is helping us here. You guys got a bunch of great white papers and resources and stuff like that. So I suggest everybody goes and checks it out. Jeff, thanks so much for coming back on the show, man. Excited.
It's my pleasure. Thanks for having me, Ryan.
All right, Tom, we got introduced from Jeff Campbell and what we were just talking about. And so if people want to see a longer conversation with Tom and I, it's on the YouTube channel. So Tom and I got introduced by Jeff Campbell, and we were just talking about how unique it is, Tom, that Jeff gets it and what Scale Bank's doing. And I think that this is because they fund working capital loans. So like that's where they got their start. So they had to understand the mechanics of business and the cost of capital and the return on equity. So as we get started, why don't you just introduce yourself to the audience? What's you and your practice, understanding a little bit more about where you're coming at this from, because I want you on because of your unique perspective of assets and cash flow and equity.
Yeah, someone finally invented a word for me not that long ago. So I'm a fractional CFO, fractional economist, and I want to emphasize the economics part because things are so complicated, and I think that there's with the way the central banks are run, the way our Treasury and our Fed has been run since long after Volcker was gone. It really creates false signals that are hard for people in small business or in any business to parse. And I actually think it creates a certain amount of temptation to act on the illusion of easy money and to make commitments that are based on that. And so, we could all wait around until gold or Bitcoin or crypto or something takes over and fixes the money for us. And I'm sympathetic to the point of view, and maybe we like it to happen, but I'm going to assume that fiat, that the unbacked U.S. dollar and all the other currencies won't go anywhere soon. And in fact, that if it really comes under existential threat, you're likely to see Powell pull a Volcker and really jack rates to make sure to keep it at the top of the currency heap.
Mm-hmm. It'd be interesting if they had the guts to do that, and what the rest of the world would do that next time. But we don't have to go there right now. But it's only a couple options.
Yeah. Go ahead.
Well, I was going to say, and so with your practice, what I find so fascinating, which is why I think it's important to have these conversations, is you've been helping manufacturers and people in the egg industry see into the future, right? Like that's what you're trying to do to generate cash flow and equity, is see into the future. So you have to think about all the different inputs.
Yeah, it's just that, and it's no one knows the future, and there's a level of radical uncertainty about what happens next. And yet at the same time, most days, one day looks like the other, the last week, and it repeats until suddenly it doesn't. Well, what happened? How do you prepare? How do you understand that? So I'm not fun at parties because I'm always interested in the downside. And I think you've got a good leadership and a good entrepreneur. They understand upside. What we want to understand is what are their exposures, and in terms of using modeling and forecasting to help them make the best play. My favorite technique is essentially to say, okay, oversimplify. You got two alternatives, A and B. What if you bet A and it should have been B? What if you bet B and A turned out to be right? What's the nature of that error? How which one is survivable? Which one fits your goals best? And you're looking at it's I don't know, maybe essentially my whole career has amounted to a great big tail hedge, where it's like a bit of insurance. An awful lot of the time, you don't need a plan. You already have a plan. You know how things work. You know what tomorrow looks like. You just
As long as your base case scenario is constantly being met, which I think it's harder now.
It is harder. That's exactly where it falls apart, right?
Yep.
But a lot of times you don't. But when you do, boy, do you need it. And if you're not been in the habit of establishing that track record, now your credibility isn't there. You don't have the same relationship with a good lender. Let's say your credit isn't portable. You're stuck with whoever will have you until they won't. And
when I think, Tom, where things really start to pinch, and I'm seeing this in a lot of the companies I've worked with, where it's like cash flow from distributions and with their lifestyle were possible while reinvesting for growth and paying taxes, and I've just watched the cash flow just shrink. So therefore it's like, okay, well, what's shrinking? Then it's either the cash flow from reinvestment, where then you're starting to finance stuff. Well, then there's the taxes, and then there's your lifestyle. And we start to see that pinch coming from the new structure of the interest rates and supply chain issues and all that stuff on the cash flow side, or whatever might happen with taxes. But there's only so much that you can deal with reinvesting, taxes, and distributions, and that is being pinched.
I'm getting anecdotes very much to that effect now, and they've been ramping up in terms of people feeling that, lenders getting nervous. And it's interesting you talk about the whole interest rate regime, because we had this really extended ahistoric period of basically zero interest rate, or as close as all of us, and I don't hold myself outside of the group. All of us have very short memories, and not only is hindsight is not even 20/20, much less foresight. So we forget what that looks like, and at this point we have a generation of financial professionals who have essentially no mature experience with a double-digit or even a 7 or 8% interest rate. The world looks very different when you have to digest that, and I think there is an old, I don't know, I can't think of the originator, and there's probably multiple sources, but low interest rates foster bad decisions.
I mean, And I think what's super fascinating and why I think, your perspective on ag and land, and as I think about for the listeners that are listening in, where it's like, okay, even if you have an operating business, I mean, it's the same thing. You have an operating company that also has, whether it's the land or it's the building, often all of that has to work while providing a return in distributions and equity growth for the owners. And what's very fascinating that you bring to the table, Tom, is the amount of data that the ag space has, and what has happened with, like, you and I were talking on the YouTube video of, like, since 71 in August, like everything, like all of the printing and all the inflation you have more data on the land pricing. And so, like, maybe give us a little bit of like what you've seen in trends that have happened to cash flows, the yield, value, because I think so much of this correlates. Because I guess what I'm trying to get to this for Tom, for the listeners, is like you and I were talking earlier of, like, people feel what's going on, and I'm trying, and I think we can do is give them some ways to articulate what they're feeling, which is like, this is real. And I think you have a lot of data and in interesting ways to say, hey, like it's synonymous of what's going on in all these different asset classes.
Yeah, I think we do have a bit of an everything bubble, and so I think we talked about earlier that assets across classes are really been in lockstep in terms of being overvalued relative to the future flow of revenues versus the cost of capital. There's that mismatch, and in farming, broadly speaking, after the '80s crisis, they scraped along the bottom for a while, but you had a period of growing profitability, and it wasn't great. No one was getting rich. Well, some people were. Generally speaking, people had their return on assets was just a little bit higher than cost of capital, but enough to stay in the game. And of course, on top of that, ever since land prices have been ascendant since the last crash, since about 1987, they've been in Minnesota. They were $1,000 an acre, and they're now, anyone's guess, and it's wobbling now, but you can almost say $10,000 an acre for prime land in Minnesota, maybe more.
Yeah, because Iowa's at 14, 15, and then
more
wild, like you and I were talking about. Yeah, even billionaires buying it for 29,000, which is off the charts. Different game being played, but
I think so. I don't know if what you have there is a total inflation hedge in place, or just an asset diversification,
but it's not a cash flow play, right? I mean, that's the thing. It's a different game than the operators that are playing.
Well, and I really can't guess as to where people are, and dominantly the way farmland is operated in well, definitely the upper Midwest. I think it's true throughout the country. Is through rents. The operating farm rents from a landlord, and they're renting, at least in Minnesota, they're renting 4/5, 3/5 of the acres under management, and then maybe they own 2/5. And so I think it's like real estate is typically a lower return investment for people who are parking money, whether it's farmland.
Because it's less risky based on the build-up methodology I did on a previous episode.
Yeah, it's a lower return. Someone has a different goal than someone who's trying to build capital for an operating business with what they need for growth, competitiveness, reinvestment, the next gen, because that's a very real thing, especially in farming. But I think it tends to be a thing in small business. I mean, they're thinking about, all right, do I have kids or nieces and nephews, or whatever, who might want to run this. And so that's a different return on assets profile. And of course, you have a fair amount of risk associated. I mean, farmland is farmland. It is productive, and it's not easy to cart it away. It's there, right? It's less so for commercial real estate, less so for residential multi-unit. So I would just instinctively, I'd expect to see somewhat higher returns there vis-a-vis farmland. But you're talking about different investor goals, but that means that for a growing business, your capital limits are such that you aren't necessarily going to want to pull money off the table that can chase 10-15% returns and park it somewhere where, even if it's economically rational, it's going to do 6 or 7 at most. And right now, of course, go ahead.
No, go ahead.
Well, right now, of course, in farmland, the return is 2-3%. It's historically low. And it's just like with everything, and my basic assumption is that there are cycles, things go up and they go down. And if they're at some historic proportionate high, then your downward exposure is more. It's just
here's where I find it fascinating, Tom, is like, so let me kind of level set us for the audience. Where like land prices have gone up, the return on the asset has gone down, and interest rates have gone up, obviously, and they could go back down. But here's where I start to lose my ability to see what the hell happens next. Tom, is like, interest rates go down, asset prices go up generally. And so like everybody, like, and I sat down with this commercial banker a couple of years ago, president of a bank. I don't think he knew more about money besides I get money and I sell it for more. Honestly, like it was, and I'm not talking about Mr. Jeff Campbell, which Scale Bank, because they fund working capital. I think they know more about operating businesses than any other bank almost out there. But like I say, what's interesting, Tom, is like, so I said all that because like this is not the same, because in the 80s, like the balance sheet of the federal government and the Fed has grown. So like it's different this time because we don't have any more room. It's like taking out your second credit card. Well, like you can't take out your fifth and sixth and seventh and eighth now. We're like, and so like this time, if we reduce rates, asset prices go up. How does this all normalize given the big trend? So maybe like, because I think it's so fascinating, some of the articles you sent over with me of like how much, like what's been going on with the trend. So if all of a sudden rates start going down, how does it recalibrate this time? Well, like what is the way to normalcy?
That gets into such macro issues, Ryan. I feel I'm really speculating in a semi-amateur way when it comes to the macro frame. I think that they either have to shore up rates in order to tame inflation and reduce the Fed balance sheet, or we are going to have a massive currency reset, probably involving debt defaults. And we're already at the point where I'm not sure if we're going to be able to avoid that. I haven't done a heavy analysis on that. I know that micro scale in terms of where Minnesota crop farming is. I'm just focused on the crop farms,
which is why I wanted you on this conversation because there's so much data and you've done this for so many years. So like, because I talk about this like big macro stuff, but like you can go into like trends, what you've seen, where you're going, and like I mean, there's very specific stuff that you can pull on.
Yeah, and that's where I sort of hang my hat, if you will. Where crop farming is. Current conditions, current known factors, and the likelihood of costs retracing to lower levels where they were just a few years ago. The average Minnesota crop farm doesn't have enough working capital in excess to navigate it. They're going to be negative. There's all sorts of but-fors. Yeah, I have some data assumptions that we won't get into here. It could be worse, it could be better, but there's a strong risk that the average Minnesota farm is going to be working capital negative before they can return to profitability, just due to cyclical factors. And a lot of reasons that they find themselves there. CapEx, if you will, excessive CapEx is one of them. So they're without cushion. So when I see that going on in a particular sector of a particular business, I feel like that's just getting fractal or something. It's a microcosm of what we're seeing in the economy. We aren't getting out of this one without a haircut. And I think at some point you stretch the currency to the point where people will abandon it, or you've got, and I'm not ready to believe that Powell is going to go full Weimar on us and having people carting their currency around in wheelbarrows.
What's interesting about that, Tom, and like I'm curious on how this impacts the egg sector is like, okay, I was talking to Brian Beaulieu a couple, 6 months ago. I'm like, okay, well, if we have $10 trillion of U.S. debt that needs to be refinanced in the next 12 months, $1 trillion of zombie corporate bonds that need to be refinanced, $1.5 trillion in commercial real estate, and whatever private equity loans are out there that are variable or not, that are just not producing the cash flow. All of these are mathematically broken based on the cash flow and the production. So then you go, well, if you keep rates at where they're at or grow them, it breaks every sector. And I got to project it. I'm assuming egg is about the same. And you go, okay, so if you have to reduce them then, and if you reduce them, we're taking what should be a junk bond and pretending it's not a junk bond, which is the US dollar and the bonds. And so you go, how does this all, I can't just go, I don't see through it.
Yeah, like I say, I sort of take solace in the micro and in the farm sector and my clients. All right, what's your play? What's your exposure? What does this look like? And
what can we control?
Yeah. How are you going to navigate? Do you have the runway in order to navigate it? And then what do the opportunities look like on the other side? But
what are some of them? Get curious on what are some of the ways that your clients are navigating this, thinking about their working capital and what the other side looks like?
They've definitely entirely avoided land buys. They just don't work. It's a dodgy proposition, even when the calculation is rational, because a landlord is a different investment creature than an operating farm. They have different needs, different risk profile, and different needs for return, as I talked about. So they're sitting that out. They're tending to watch their capex. They're watching their debt structure too, in order to maximize as much as they can long-term stable debt, and sometimes at low rates. The rate is less important than just the fact of having stable debt that's not susceptible to, we're not going to loan to you anymore. So they've moved towards trying to be able to finance most of their operations out of cash, and arguably they've forgone some growth. And I'm paid as a tiny percentage of the top line, so I love growth. In fact, if anything, I'm biased towards it, but. It has
interesting.
To be profitable. It has to be profitable for them. Otherwise, they decide that maybe I'm not worth the trouble, and they're right. So that's
which is very fascinating to stumble across someone like you who, because I think everybody's all about growth, but they're starting to see that the bottom of it doesn't make any sense. It's built on something that's not stable. But like your talk about cost of capital, return on assets, and cash flow is that's reality, right? And so like you have the ability to kind of have a foot in each bucket.
Yeah. On the national scale, I probably looking at history of hopefully not Weimar, but looking at even the U.S. in the 1930s and what FDR did with gold, which some people say is constructively basically theft, and you can look at maybe the pattern of South American countries with routine currency debt defaults. They're still there and they're still productive, some of them, and they still have assets and they still have talented people. So I don't, when I see something that might be fairly drastic financially, I don't see that as the end of the U.S. In fact, I think maybe it's a bit of a reset that we're overdue for, because
maybe that's the reset that we're looking for. And and that's why I love ITR Economics' book called The Prosperity and the Age of Decline, because it's like, don't get hung up in the crap. It's like, this is how the next gen creates their wealth, and it's a good mindset, food for thought.
I think so. I think the opportunities, and I'm really blessed to have clients who maybe I've helped, but I think it's just their mindset to be clear-headed about this. So when they see the risk, when they see the trouble starting, they say, this is also opportunity that I've already waited a long time for. And so when I see it, I feel like,
I like that.
Now I can see my future. If you got a farm and they've got 5,000 acres under management, and they've got 2 or 3 kids, and they already are expressing an interest, and they're finding that, well, I don't have room for all of you. They want to grow, but they've got to. It's got to be smart growth, and so they are starting to see maybe the path forward. And it's a bit bloody-minded, because you are also talking about let's say the lesser operators making an exit from the business, which is heartless. But I think the reality is those who are making the exit have been consuming capital to stay in. And so the sooner they come to terms, let's say, and make an exit, whatever your business is, the sooner you stop with with your personal capital strip mine, and the more you have left over to move on to the next thing, and actually even endow the next generation. So I think that.
Well said. I like that a lot. I mean, that truly is the recalibration, right? I mean, it should happen that way.
Yeah. So yeah, Ryan. Thank you. It does make me a little bit more positive than the negative. I think the bad news is, if someone knocked over a building that no one needed, the bad news happened when they made it. Not when they finally pulled it down, right? That's fast.
Yeah.
Yeah.
Well, this has been super fun. Is there, as we're looking at potentially having some repeat visits and conversations, is there KPIs that you like to think about for owner operators? Like, what are some of the things that you're paying attention about or paying attention to that, like when we're having another conversation, we can kind of update on how things are working in different kind of numbers or, things in the economy that you're paying attention to?
What I look at, cost of capital,
return on asset value, or return on equity.
You know what? It's going to be. It's always down to a few things. What do these look like, and how do they project out? And it's return on assets. It's days operations and cash, and if there's a difference, days operation and working capital, and it's proper debt structure. Term out stuff wherever you can. Actually, it's an old one, but I think it still holds true. Atypically we favor C corporations. They're a little bit cleaner in terms of maximizing your tax treatment of losses and holding on to liquidity, especially in farming. That's sort of it's a minor technical discussion that dates back to our CPA days, but I think it still largely holds true, and people don't favor it because of this whole specter of
double taxation, etc.
Well, that's only if you have like a uncontrolled re-entry into the atmosphere. You can plan out these things, and it's something that I haven't really explored a lot, and it's maybe a detail, but sometimes, especially in agriculture, where they have such long production cycles and such heavy prepays, it can be a pretty big deal. And last thought, Brian, in terms of risk exposure, and this is really true in ag. To manage taxes, you end up doing heavy advance payment on next year's inputs, and now everyone's used to it, so you're doing heavy prepays, seed, fertilizer, chemical. You're deferring crop revenues. I mean, let's say, you've delivered the corn, and you're saying, hey, don't give me that check until January 2nd. Don't mail it. Don't do anything. You're just taken at the behest of your elevator, of your vendors. You've taken a massive unsecured creditor position, and if things get ugly enough, that can bite you. And that's really dark. But things are fine until they're not, and that's.
Well, I watched in the event space, Tom, during COVID. Who had the money was very obvious. Like when you were doing prepayments for events, and that was a wild situation.
Oh yeah, no kidding. I mean, there are a lot of iterations of that sort of thing where you're de facto unsecured creditor, and that can get dodgy in agriculture just because the amounts of money involved, and we have personal anecdotes of people who got on the wrong side of a failed elevator.
Yeah. And you think about even with the interest rate risk and all the debt stuff going on. Like one final question, actually, I forgot to ask. So I was trying to think about, why is it that crop prices go down when interest rate goes up? It's counterintuitive to me for some reason.
I don't know, and there's a really strong negative correlation. It's amazing. It's also uncanny, and my best guess is higher interest rates are indicative of a stronger dollar relative to our trading partners, which makes our corn more expensive abroad.
Okay.
So
okay.
That
can make that, and then they would have to reduce the prices.
Yep.
To help our partners abroad, because we have a strong dollar. So if the interest rates go down, we should see prices go back up for the egg industry. Interesting.
Yeah, I can't think of any other factors.
That makes sense. I could see that. I could totally see that.
No,
Tom,
fair
this has been
question.
super fun. You have a blog that I think is worth following for people that, again, I think what's so fascinating about having you on is, yes, we're talking about egg, but I think it is so synonymous with operating businesses, the commercial real estate they have, return on equity, cash flow, working capital. You're paying attention to the right stuff, which I think is great. And you put out a bunch of articles that I think are worth a listen and are worth a read. Where can people find you?
Well, walkerinsight.com, and there's a tab that says blog, and that's the
You got data out there, man. It's fun.
Yeah. I'm not very prolific. I do okay writing, but I'm a horrible writer in the sense that it takes me forever to get a product out.
Well, you do a good job, though. I mean, I
appreciate that.
It's comprehensive. Yeah.
Yeah.
Well, this has been so fun, Tom. I'm glad you were able to come on.
Oh, likewise. Enjoyed it very much, Ryan, and look forward to next time for sure.
Hope you enjoyed that episode. If there's anything that I would do is I would go pick up the Prosperity in the Age of Decline book by the ITR Economics brothers, because it is amazing and it's so relevant, and it's 10 years old, and it just shows how much more ridiculous things have gotten. Go check out any of ButcherJoseph's material on their website. They have a ton of amazing downloadables. And then Tom Walker on Walker Insights has got a bunch of material as well. And then for next week, I've got Casey Brown, who is a pricing specialist geek, and she's amazing. She probably talks faster than me, and I can't tell you how much fun I had. I asked a bunch of my friends and clients what questions they would have about pricing, especially in the age of inflation and margin compression and consumer issues. And Casey over-delivered, and I was super pumped to have her on the show. So share this episode with anybody else, and then make sure to stay tuned for Casey's episode next week. Thanks, everybody.